My name is Zara. Stop what you are doing right now. Because what I am about to share with you could change the way you think about your money, your future, and one asset that most people walk right past without ever understanding its power. Silver. Not jewelry, not museum coins. I am talking about silver as a serious, strategic, long-term investment. And I am going to tell you why 2026 may be the last real opportunity to position yourself before this metal does something most investors are completely unprepared for. But first, a story. My story. I was 26. I had just started taking my finances seriously, saving every month, reading everything about investing, stocks, real estate, index funds. And in all that reading, I kept stumbling across silver. Forums were talking about it. Analysts were quietly writing about industrial demand shifts. Long-term investors were making careful arguments that silver was deeply undervalued. I read those arguments. I understood them. And then I did what most people do with uncomfortable, unfamiliar ideas. I moved on. I told myself I would come back to it. I told myself I needed to understand it better first. 2 years later, silver moved. Steadily. Quietly. With the kind of sustained momentum that only happens when fundamentals finally align with market reality. And I watched it happen from the outside. That was not a loss I could calculate in numbers. It was the loss of a lesson I had been handed but refused to receive. So today I am making sure you do not make the same mistake. Now. The most basic question every smart investor asks before putting a single dollar into anything. Why does this thing have value? Gold gets all the attention, the mythology, the prestige, 5,000 years of human civilization. People understand gold even if they cannot fully explain it. Silver exists in that same category, but silver has something gold does not. And this is what makes silver's story in 2026 fundamentally different from any previous era. Silver is not just a store of value. Silver is a critical industrial material, and the world is entering a phase of industrial transformation that will consume silver at a scale with no historical precedent. Solar panels require silver in their photovoltaic cells. It cannot simply be replaced with something cheaper. The physics depend on silver's unique properties. The solar industry alone consumed approximately 160 million ounces of silver in a recent measured year. That number is growing as solar installation targets accelerate across Asia, Europe, and North America. And solar is only one driver. Electric vehicles use silver in electrical systems and battery management circuits. The semiconductor industry uses silver. Medical devices use silver. Defense and aerospace use silver. This is not a metal waiting for someone to believe in it. This is a metal being pulled from every direction by the physical requirements of the modern economy. Now here is where it gets truly interesting. Silver supply is constrained. Approximately 70% of silver produced globally is a byproduct of mining for other metals: lead, zinc, copper, gold. When demand for those metals fluctuates, silver production fluctuates with it, regardless of what the silver market needs. Opening a new silver mine takes years. Permitting, construction, workforce development. Supply cannot simply respond quickly to rising demand. Rising industrial demand, constrained supply. That is the fundamental equation. And there is another layer. For most of recorded financial history, silver played a monetary role alongside gold. Coins were made from it. Currencies were backed by it. That monetary history did not disappear when central banks moved away from metal-backed currencies. It created a deep understanding of silver as tangible wealth, one that resurfaces powerfully whenever people lose confidence in paper money. Where are we in 2026? Government debt levels at historic highs. Central banks navigating the consequences of years of money printing. Inflation that has permanently altered household purchasing power. Trust in financial institutions at generational lows in many countries. This is the environment in which silver is entering its industrial demand surge, which means silver is benefiting from two forces simultaneously: industrial necessity and monetary refuge. The demand to use it and the demand to hold it. That combination is rare. That combination is powerful. One final clarity before we close part 1. I am not telling you silver will double next month. Anyone who says that is selling you something. What I am telling you is that the structural case for silver over the next 3 to 5 years is stronger than at any previous point in modern financial history. This is not about getting rich quickly. This is about positioning yourself intelligently based on real fundamentals before the majority of investors catch on. Because by the time your neighbor is talking about silver at dinner, the opportunity phase will be largely over. The most expensive words in investing are not, "I lost money." The most expensive words are, "I knew about it, I just never did anything." In this part, I am going to give you the single analytical framework that separates informed silver investors from everyone else: the gold to silver ratio. Simple concept. You take the current price of gold and divide it by the current price of silver. The result tells you how many ounces of silver it takes to buy 1 ounce of gold. For most of human civilization, this ratio lived in a very specific range. Ancient Rome placed it at roughly 12 to 1. Centuries of Western monetary history averaged 15 to 20 to 1. When the United States established its bimetallic currency standard, the official ratio was set at 16 to 1. These numbers were not arbitrary. They roughly reflected the natural abundance of silver relative to gold in the Earth's crust. Hold that historical baseline: 15 to 1, 16 to 1. Today, in 2026, the gold to silver ratio sits dramatically above that norm. In recent years, it has ranged from 60 to 1 on the low end to over 90 to 1 at various points. In simple language, silver is, historically, significantly, measurably cheap relative to gold. Now let me be precise. This does not mean silver must return to 15 to 1. Financial markets are not bound by historical precedent mechanically. What it does tell us is the direction of probable mean reversion. When any asset trades at a historically extreme valuation relative to a closely correlated asset, there is a persistent tendency for that gap to narrow over time. Here is the key question. What would have to happen for the ratio to move back toward, say, 40 to 1, still well above historical norms? Either gold falls significantly, or silver rises significantly, or both. In an environment where gold itself is performing strongly, where central banks globally are accumulating gold reserves at some of the highest rates in decades, what is the probability that gold collapses dramatically? Most serious analysts consider that probability low, which means the burden of closing the ratio falls disproportionately on silver rising. Concrete illustration. If gold stays exactly where it is today, and the ratio moves from 80 to 1 down to 40 to 1, silver doubles, without gold moving at all. simply from the ratio returning to less extreme levels. This is why sophisticated precious metals investors say silver provides leveraged exposure to gold. It tends to move in the same direction as gold, but with greater amplitude in both directions. That leverage is a double-edged reality. Silver falls harder in downturns and rises faster in strong cycles. For the patient, long-term investor, that leverage is precisely the feature that makes silver potentially transformative. There is one more dimension of the ratio story. The above-ground stockpiles of silver relative to gold have changed dramatically. Silver is consumed by industry in a way gold is not. When silver is used in a solar panel or a circuit board, it is dispersed in quantities so small that recovery is economically impractical. It is effectively consumed. Decades of this industrial consumption have significantly reduced the above-ground silver stockpile relative to gold. Some analysts argue that the investable silver supply is now actually smaller relative to gold than the price ratio suggests. If correct, the current price ratio dramatically understates silver's scarcity. Now the right question. If silver is so clearly undervalued, why has it not already moved? Honest answer. Markets can remain inefficiently priced longer than seems rational. Institutional capital has preferred allocations. Momentum-driven investors wait for confirmation. Retail investors have limited attention and knowledge. These factors can keep an asset in a holding pattern even while fundamentals build in its favor. Silver has also been range-bound partly because the macro environment has been uncertain. Gold gets the initial flight to safety capital. Silver accelerates in a second phase, once the fundamental dynamics are clearly established. And most importantly, the industrial demand surge is not a past event. It is an accelerating present event. The solar numbers are growing. The electric vehicle curve is steepening. These forces are building in magnitude. What we are seeing is the early stages of a demand shift whose full weight has not yet been priced in. Understanding these dynamics is not about convincing yourself silver is a sure thing. It is about recognizing that the probability distribution of outcomes for silver over the next 3 to 5 years is skewed in a direction that rewards patient, informed positioning. There is a particular kind of pain in investing that is different from simply losing money. It is the pain of losing money on something you were right about. Being right about the asset but wrong about the approach. In silver specifically, this mistake is extraordinarily common. So in this part, we are talking about what actually goes wrong and the principles that protect patient investors from destroying a genuinely good thesis with poor execution. The first mistake, the urgency trap. When investors encounter the kind of argument I have been making about silver, something happens in their psychology. The information feels important and urgent. And urgency, in an investing context, is almost always dangerous. Here is how it works. You hear a compelling argument. You feel behind. You feel like the window is closing. You act quickly, without deeper research, without understanding volatility, without a position size appropriate to your situation. You put in more than you can comfortably hold through a drawdown. And then, silver does exactly what it tends to do short-term. It corrects. It consolidates. It moves sideways for months. And because you entered with urgency rather than conviction, you panic. You sell near a local low. And you lock in a loss on an asset that, held with patience, would have justified your original thesis. The antidote is structured conviction. Silver's thesis is not an emergency. It is an opportunity. Those are different things. Silver's industrial demand is not resolving in 60 days. The supply constraints are structural. The macro environment is persistent. The ratio will normalize over years. This is a multi-year thesis. It deserves multi-month position building, not panicked overnight allocation. The practical implication is this: build your position gradually. Smaller, consistent purchases over 6 months to a year, rather than one large purchase made under pressure. This approach converts volatility from a threat into a feature. When silver dips, your next purchase buys more ounces. When silver rises, your existing position appreciates. Over time, your average cost reflects the actual market range. The second mistake: format confusion. Silver can be held in multiple forms: physical silver, bars and coins; silver ETFs; silver mining stocks; silver futures. Each has a fundamentally different risk and return profile. Many investors lose money not because their thesis was wrong, but because they chose the wrong format for their goal. Physical silver offers direct ownership with no counterparty risk and no management fees. Best for monetary hedge purposes. The disadvantage is storage, insurance, and dealer spreads. Silver ETFs offer liquidity and convenience through standard brokerage accounts. They carry management fees and counterparty risk, but are practical for investment thesis exposure. Silver mining stocks offer leveraged exposure to silver prices. When silver rises, well-run miners can rise faster because profit margins expand dramatically. But they also carry company-specific risks that have nothing to do with silver's price. Futures are instruments designed for sophisticated traders. They involve leverage, expiration dates, and margin requirements. For the long-term, conviction-based approach I am describing, futures are almost never the right instrument. The mistake is defaulting to whichever format you encountered first, without understanding what you own. Know what role you want silver to play, then choose the format that serves that role. The third mistake: thesis drift. An investor builds a position based on a solid, grounded thesis. Silver is not moving the way they expected short-term. Discomfort grows. They start finding increasingly extreme predictions online. They shift from their original grounded argument to a more excitable, speculative narrative. Now they are managing a fantasy, not an investment. When silver eventually moves, the fantasy tells them it must go much higher, so they take no profits. When silver corrects, the fantasy says it is temporary, so they do not reassess. They end up with worse returns than their original thesis would have delivered if held with simple fidelity. The protection against thesis drift is documentation. Write down your thesis before you invest. Write down the specific reasons you believe in it. Write down the conditions under which you would reduce your position. Revisit what you wrote periodically and ask yourself honestly whether you are still managing your original thesis. Good investing is not exciting. That is one of the hardest things for new investors to accept. Good investing is methodical, patient, and consistently disciplined. The dramatic, urgent predictions you see in financial content are almost always noise rather than signal. Silver's real story is a long, patient, fundamentally supported accumulation thesis. Investors who approach it that way end up on the right side of it. No single asset saves you. Not silver, not gold, not real estate, not the most brilliant stock pick you ever made. Wealth is built through the intelligent construction of a complete financial ecosystem, a system where different assets serve different purposes, where risks are balanced, where no single event can devastate your entire financial position. Silver's role in that system is specific and powerful, but it is a role within a larger architecture, not an architecture unto itself. The first question: how much of your portfolio should be in silver? There is no universal number, but there is a framework. I call it the sleep test. Whatever position you take in silver, size it such that if silver fell 40% tomorrow, you could hold without losing sleep, without making panicked decisions, without disrupting your financial commitments. If a 40% short-term decline in your silver holding creates genuine anxiety or financial hardship, your position is too large. Reduce it until volatility is tolerable rather than destabilizing. Silver's history makes a 40% drawdown within a larger bull cycle entirely plausible. The investors who held through previous corrections and ultimately benefited from the full cycle were investors who had sized their positions to survive that turbulence. The second framework is role definition. Ask yourself what silver is doing in your portfolio. If it is primarily a monetary hedge against currency debasement, you are thinking about a smaller, more permanent allocation. Physical silver makes the most sense. The goal is not to trade for gains, but to hold as protection. If it is primarily an investment thesis on industrial demand and price appreciation, you are thinking about a more actively managed allocation. ETFs or mining stocks may be more practical. You might take partial profits as the thesis plays out and monitor the fundamental indicators over time. Most thoughtful investors hold some combination of both. A reasonable allocation range that many long-term investors use is 5 to 15% of their overall investment portfolio in precious metals broadly. Large enough to meaningfully impact performance when precious metals outperform, not so large that it creates destabilizing volatility for the whole portfolio. Now I want to address something that often gets overlooked. Silver should not compete with your emergency fund. It should not compete with your debt repayment. It should not compete with your retirement savings in tax-advantaged accounts. If you carry high-interest debt, paying it down is a guaranteed, risk-free return equal to the interest rate you are carrying. No investment thesis reliably outperforms eliminating a credit card balance. Debt elimination comes first. If you do not have a liquid emergency fund covering 3 to 6 months of expenses, you are not ready for silver's volatility. If an emergency forces you to sell during a correction, you lock in losses at exactly the wrong time. Build the foundation first. If your workplace retirement account offers employer matching, not contributing enough to capture that match is leaving guaranteed money on the table. Max your match before allocating to silver. These points are not exciting, but they are the foundation that makes everything else work. One more principle I consider foundational to every serious investing decision I have ever made. Consistency beats brilliance. The investor with perfect timing and maximum allocation will technically do better than the disciplined, patient, systematic builder. But the perfectly timed investor is essentially mythological. The disciplined, consistently contributing, appropriately sized investor is a model accessible to anyone. Silver's thesis is a multi-year story. The industrial demand is building. The supply constraints are structural. The monetary dynamics are persistent. The ratio asymmetry is measurable. These forces do not resolve in a week. They play out over years. The investor who starts building a thoughtful position today, even imperfectly, even modestly, and adds to it systematically, learns from it consistently, and holds it with patient conviction, is very likely to be in a better position than the investor who waits for perfect clarity before acting. Perfect clarity never comes. By the time everything is obvious, the opportunity is gone. Act with enough information. Act with appropriate sizing. Act with a long time horizon, and let the structural forces work on your behalf. We have traveled a long way together, From why silver has value, to the analytical power of the gold to silver ratio, to the psychological mistakes that destroy good theses with poor execution, to the disciplined framework for integrating silver into a complete, healthy portfolio. Now the final part, and I want your full attention here, because this is where I will be the most direct, the most specific, and the most cautionary. Let us talk about what 2026 and beyond could look like for silver. Not predictions, scenarios. The bull case rests on several reinforcing pillars. Solar energy installation is accelerating globally. Government targets are backed by subsidies, regulatory requirements, and committed infrastructure investment. The manufacturers building those panels need silver. These are not speculative numbers. They are the product of announced targets and known silver content per panel. Electric vehicle adoption is past the early stage. The consumer curve is bending upward. Each vehicle contains silver, and as the installed base grows into the hundreds of millions, the embedded silver demand becomes increasingly significant. The semiconductor industry continues to expand as artificial intelligence and advanced electronics drive chip demand at unprecedented scale. Silver's role here is quiet but real. The macro monetary environment favors tangible, scarce assets. Elevated government debt, inflationary pressures, currency uncertainty. These forces are not going away quickly, and silver remains dramatically under-owned relative to gold in most institutional and retail portfolios. When silver begins to move with genuine momentum, the inflow of new capital responding to that momentum has a long way to travel. That is not hype. That is supply and demand of investor attention. Now the risks, because you deserve the honest picture. A slower than expected global energy transition would reduce silver's demand growth. If policy priorities shift or economic pressures delay renewable deployment, the demand case weakens. A severe global recession would hurt silver short term. Industrial metals fall when economic activity contracts. The monetary demand side might provide some offset, but price pressure would be real. Technological substitution is a long-term risk worth monitoring. Researchers are working on solar cell technologies that could reduce silver's role. No commercially viable substitute is imminent, but this is worth following. A sustained period of dollar strength typically suppresses commodity prices in dollar terms, even when the underlying asset is sound. Understanding these risks is not a reason to abandon the thesis. It is a reason to hold it with intellectual honesty, to monitor the right indicators, and to be willing to update your view when evidence changes. Now the warning. And this warning is not about silver specifically. It is about the relationship between information and action that determines whether any investment thesis becomes a force for positive change in your financial life, or becomes another story about how you were almost right about something important. The warning is this: information without a framework for action becomes anxiety, and anxiety masquerades as preparation. Across these 5 parts, you have received substantial information about silver: the industrial demand dynamics, the supply constraints, the ratio analysis, the historical context, the portfolio principles, the risks. You now know more about silver than 90% of investors who will ever buy it. But knowing is not doing. And doing without a framework is as dangerous as not doing at all. The trap I see most often is people consuming more and more financial information and feeling progressively more anxious and confused, rather than more capable and clear. They know about silver. They know about gold, index funds, real estate, dozens of investment ideas. And instead of clarity, they have paralysis.